Hey, what's up traders, welcome to a new video. So in this video I'll be going over the most popular trading indicator ever. So there are many trading indicators on the market. Some are free, some are paid, but there's one indicator which is also being used by big institutional traders. So first of all, let's go to TradingView. If you do not have an account, you can just check out the link down below and create a free account. So this is a trading charting platform, so you see all kind of charts of stocks, forex, currencies, or indices, whatever. So yeah, just create a free account. Over here we have the alt cut, and we see here the section indicators. So I click on that, and one of the most popular indicators ever is the moving average. So moving average, we have a few listed over here: the exponential, the simple, the smoothed. There are many moving average types, but the indicator that even the institutional traders use the most is the moving average simple. It's just a simple moving average. And I click over here on the settings part, and then we can play around with the length. Now we see it over here as a line that is close to the chart, right? Because it has a length of 9. But let's play around and use a 50. Now we see that the line changes. What it does is that it looks at the last 50 candles and it takes the average price of that, and it is a line over here, right? So we see that if price is above the 50 simple moving average, the market is in a uptrend. So over here, price is above the 50 level, we see price goes to the upside. But as soon as it crosses the 50 level, we see that price goes to the downside, right? Overall, because it doesn't apply to every situation, because over here we see price crosses the 50, moves a little bit to the upside, but then we still go down eventually, right? So it doesn't work every single time, but in general we can say the 50 moving average indicates a nice trend. Another length that is being used by institutional traders, 200 simple moving average. So let's take a look. Over here we change it from 50 to 200. And now we see again that the line is different than the 51, right? We see over here that we see bigger trends. So it crosses the 200 line and it keeps moving to the upside for a long time until over here it ranges a little bit, but then it stays below the 200. And this is on a daily level, right? I'm looking at the daily time frame. So we see prices below the 200 daily moving average, and we are in a downtrend. Here we see it was a little bit to the upside. So here we have from March until April, May, we are in the bullish market, but it drops down again below the 200 moving average, and we see price stays below the 200 moving average for a long time. So that is also a length that many institutional traders consider. But what if we combine these lengths, right? We combine the 50 and the 200, or maybe the 100 moving average. What if we do that? So what you can do is that you go to indicators. As mentioned, you can look for the moving average, but there are also indicators that enables you to combine the moving averages in one simple indicator. So over here, let's say that I look for moving average. Over here we see that we have the exponential moving average and a set of 3, but we also have the 10 in 1 different moving averages. So when I click on that, I already have it listed. Let me delete that one. So that is over here. We can use many different indicators, many different in this case, moving averages in one indicator, right? So we have the 50, we have the 200, we have the 800, but we're able to use 10 different moving averages in one indicator, right? So in this case, I'm looking at the exponential moving average because personally I like the exponential moving average, but you can play around with for example, the 200 simple moving average and the exponential moving average, and you can find out what the difference is. But personally I like the exponential a little bit more. So let's say that we only look at the 200 simple and the 200 exponential moving averages. So we remove the other ones. So yeah, we see that it is different, but not a lot, right? So we see that price crosses both, and we see price stays above the 200 exponential and the simple moving averages. But over here we see that it is below both moving averages, and it means we're in a downtrend. The simple one is different from the exponential moving average, but it's not major, right? So let me get the 50 exponential moving average, and we have the 800. This is also something that I like to look at. So over here, what do we see? We're still looking at the daily time frame. We see here that, let's zoom in a little bit, price is below all levels. Price is below the 50 exponential moving average, that is the red line. The black one is the 200 exponential moving average, and the gray one is the 200 simple moving average, and we have the 800. So this is the long-term exponential moving average. So price is below all levels, right? All moving averages, and we see it goes nicely to the downside. So if you took sell orders, those would be profitable. We go below every time when it's below the 50 and all the other moving averages, it goes to the downside. We make profit, right? Until we see that this is something, a situation in which you do not trade, until price over here is above all moving averages. So you wait for, let's say, a support. So this used to be a resistance, but now support. So if you took a buy, boom, it would be profit. Again, if you took a buy, it would be profit, but you do not trade it because over here we see it's below the 50 moving average, right? So you wait for another moment, it goes to the upside, a nice retest on the 50 level, and then we see we take a buy, we go to the upside, and it's profit, right? So these moving averages, they are really useful to find out where is a trend and in what situation are we right now. So what also people do is that they look at the 50 exponential moving average and the 200 exponential moving average. So the simple doesn't really matter that much, but every time when we see a cross, the trend switches. So over here it is above right now, above the 200, but over here we see it crosses, right? We see it crosses the 200 exponential and the simple moving average. So from that moment we only look for sell opportunities. Indeed, price goes to the downside. So every time we took a sell trade, then we made some profits, and this is what we call a death cross. When the 50 exponential moving average, or the simple, doesn't matter, but when the 50 moving average crosses the 200 to the downside, we call that a death cross. And the opposite is also true. When it crosses the 50, it crosses the 200 to the upside, we call that a golden cross. So we only look for buy opportunities. But as you can see, I also use the 800 exponential moving average. So even though we see a cross to the upside, it doesn't mean that we can look for buy opportunities, because price is still below the 800 exponential moving average, right? So we do not look for buy opportunities, we only look for sell opportunities. And then we simply wait for another cross, a death cross. 50 crosses the 200 moving average, so then price also below the 800, so we only look for sell opportunities. That's the only thing we do. Over here we see a cross, we do not buy. Why? It's below the 800, right? Over here we see a cross to the downside, and this unfortunately didn't work out, and that's okay. It happens because yeah, trading is a numbers game. So not everything works 100%, but if it works, let's say 80%, I'm good. So again, yeah, the moving average is an indicator. It is one of the most popular indicators out there, and even institutional traders use this indicator. It's a really popular and really helpful and probably one of the best indicators out there. So if you like this video, give it a thumbs up, subscribe, and watch the next video that the YouTube algorithm recommends to you.